Hey everyone, welcome back to Corporate Decoded, the place where we uncover the hidden stories in company filings. Today we're dissecting Westin Acquisition Corp's latest 10Q, a report that has got more twists and financial turns than a roller coaster ride. You are not going to believe some of these numbers, and hey, if you are new here, make sure you hit that subscribe button and join our Discord community. The link is in the description below. Alright, let's dive into this quarterly report from Westin Acquisition Corp. This filing is essentially a check-in on the company's financial health for the quarter ending the 30th of September 2025. Think of it like a doctor's report for a business telling us how it is doing. Now, Westin Acquisition Corp is a bit of a special case. It is a blank check company, often called a SPAC. These companies are basically created to find another business and merge with it, effectively taking that other business public. They don't have much in the way of operations themselves. Their main job is to find a deal. When we look at the balance sheet, which is like a snapshot of what the company owns and owes, we see some key figures. As of the 30th of September, 2025 deferred offering costs were $460,563, a pretty big jump from $200,000 at the end of June. This suggests they were spending money preparing for something big, like their upcoming IPO. On the liability side, there is a promissory note related party listed. This means someone connected to the company loaned them money as of the 30th of September 2025. This amount was $449,377, up significantly from $184,475 earlier in the year. This indicates the sponsor was providing more funding to keep things running as they prepared for their public debut. In the shareholders' equity section, we see Class B ordinary shares. This is typically stock held by the founders or sponsors of a SPAC. There were 2012500 of these shares issued. The additional paid in capital is $24,799, which is a very small amount. Again, showing this is a shell company at this stage. Their accumulated deficit was $13,814, meaning they had spent more than they had earned, which is totally normal for a company in this phase. Now let's look at the statement of operations. This is where we see how much money they made and spent. For the 3 months ending the 30th of September 2025, the company reported a net loss of $4,339. This is not unusual for a SPAC, as their primary expense at this stage is formation costs. For the period from inception through the 30th of June 2025, the net loss was $9,475. These are very small numbers because, remember, they hadn't even had their IPO yet. The weighted average shares outstanding were 1,750,000. This is important when we look at earnings per S-share. The net loss per S-share for the quarter was a tiny $0.002. This is so small it is practically zero, again because they are not operating a business yet. The statement of changes in shareholders' equity confirms the story. On the 3rd of June 2025, the company was formed. The sponsor then issued 2,012,500 Class B ordinary shares, along with $24,799 in additional paid-in capital, making up the initial shareholder equity. The net loss for the period between inception and the 30th of June was $9,475, putting the total shareholder equity at $15,525. After the September quarter, another net loss of $4,339 brought the total equity down to $11,186. Turning to the cash flow statement, this tells us how cash moved in and out of the company. For the 3 months ending the 30th of September 2025, there was no net cash provided by operating activities. In fact, the net cash used in operating activities was $0 after accounting for the formation costs. It is the same story for the period from inception through the 30th of June 2025. This reinforces that their cash hasn't been generated from actual business operations. What is interesting here are the supplemental disclosures. We see deferred offering costs paid by the sponsor under that related party promissory note. For the September quarter, this amount was $260,563, and for the earlier period, it was $175,000. This shows the sponsor was fronting money for the IPO costs, which is a common practice. Let's dig into the notes to these financial statements. Note 1 tells us that Westin Acquisition Corp was incorporated on the 3rd of June 2025 as a blank check company. Their purpose, as typical for SPACs, is to find a business to combine with. As of the 30th of September 2025, They hadn't started any real operations, and certainly hadn't found a merger target. This is a crucial detail. The report mentions that on the 5th of November 2025, which is after the reporting period ended the 30th of September, the company completed its initial public offering, or IPO. They sold 5750000 units at $10 each, raising a total of $57,500,000. This is when they really started bringing in the big money. Also happening on the 5th of November 2025 was a private placement. The sponsor bought an additional 235,000 units, also at $10 each, bringing in another $2,350,000. This is common for SPACs to have a private placement component to boost their capital. Over $57.5 million from the IPO and $2.35 million from the private placement were placed into a trust account. This trust account is where the IPO money goes, and it is generally only used for the business combination or if the company liquidates. In note 2, we get into the accounting policies. They mention they are an emerging growth company, which means they get some leniency on certain reporting rules. This is standard for newer companies going public. Under offering costs associated with the IPO, it explains that costs related to the IPO, like underwriting fees and legal expenses, are deferred. They are capitalized on the balance sheet and will be subtracted from additional paid in capital once the SPAC deal is completed. If the SPAC deal falls apart, a major change happens, and these costs basically get expensed immediately. The company calculates net loss per ordinary share by dividing net loss by the number of shares outstanding, but they exclude shares that might be forfeited. As of the 30th of September 2025, they didn't have any dilutive securities, meaning no complex financial instruments that could turn into shares and impact earnings per S-share. So diluted earnings per S-share were the same as basic. Note 3 goes into more detail about the IPO that happened just after the reporting period. It confirms the 5,750,000 units sold for $10 each, totaling $57,500,000. They also mention the underwriters over, allotment option which they exercised, meaning they sold even more shares than initially planned. Total offering costs were about $2,160,563. Note 4 details the private placement. 235,000 units were sold to the sponsor for $10 each, raising $2,350,000. These private units are like the public units but have restrictions on selling them right away. Scroll note 5, related party transactions. Scroll now. Note 5 is interesting because it talks about related party transactions. This means dealings between the company and its insiders or affiliated entities. The sponsor acquired 2012500 Class B ordinary shares called initial shares for $25,000, that is about 1.2 cents per S-share. These shares have certain lockup periods, meaning they can't be sold immediately after the IPO. Then there is the promissory note related party. The sponsor agreed to loan the company up to $500,000 for IPO expenses. As of the 30th of September 2025, $449,377 had been borrowed under this note. It is non-interest bearing and unsecured. The report explicitly states this outstanding balance was repaid upon the closing of the IPO. The company also pays an affiliate of the sponsor $10,000 per month for office space and administrative support. This is a common arrangement. Note 6 covers commitments and contingencies. This is where we see things like registration rights. Holders of the initial shares and private units have the right to demand that their shares are registered for public sale under certain conditions, which is standard for SPACs. The underwriting agreement details fees. The underwriters get a cash commission of 2.0% of the IPO proceeds, and crucially, a deferred underwriting discount of 4.0% of the IPO proceeds. This deferred commission, a sizable $2,300,000, will only be paid upon the successful completion of a business combination, and it comes out of the trust account. Note 7 provides details on the shares. Class A ordinary shares are authorized at 450 million, but none were issued or outstanding as of the 30th of September 2025. The Class B ordinary shares held by the sponsor totaled 2012500. Up to 262,500 of these were subject to forfeiture if the underwriters over allotment option wasn't fully exercised. But as we saw, it was fully exercised on the 5th of November, so those forfeiture risks disappeared. Note 8 discusses segment reporting. For companies with different types of businesses or operating in various regions, they have to break down their financial results by segment. But here, Westin Accession Corp reports only one segment because it is a single entity focused on finding one business combination. Their chief executive officer reviews the company as a whole. Finally, note 9, subsequent events, talks about things that happened after the balance sheet date of the 30th of September 2025. But before the report was filed, it reiterates the IPO and private placement on the 5th of November 2025 and the $57,500,000 placed in the trust account. This section basically confirms the major steps taken shortly after the quarter ended. Now for the management's own take on things in item 2, the management's discussion and analysis. They reiterate that they are a blank check company with no operations to speak of. Their primary activity has been getting the IPO done and now looking for a target. They confirm no revenues to date, and the net loss of $4,339 for the quarter was due to formation and operating costs. They anticipate non-operating income in the form of interest income from their trust account investments, which sounds pretty safe and sound. Under liquidity and capital resources, they again mention the IPO and private placement proceeds of $57,500,000 and $2,350,000 respectively, with the bulk going into that trust account. They plan to use these funds for their initial business combination. They also state that as of the 30th of September 2025, they had no cash and a working capital deficit of $449,377. This was covered by the sponsors' loans, which were repaid after the IPO. This part is important. They acknowledge they have a limited time, 18 months from the IPO, to find and complete a business combination. If they don't, they will have to liquidate. This uncertainty is why they've determined there is substantial doubt about the company's ability to continue as a going concern. This is a standard disclosure for SPACs, highlighting the inherent risk that they might not find a deal. In item 4, controls and procedures, the company admits that their disclosure controls and procedures were ineffective. Specifically, they mention lacking adequate controls to ensure they identified and timely disclosed all agreements requiring disclosure for commitments and contingencies in their financial statements. This is not ideal, but it is also not uncommon for newly public companies trying to get their reporting systems up to speed. As a smaller reporting company, they are, thankfully for us, not required to go into deep detail on risk factors here. But we know the main risk for any SPAC is failing to find a suitable business combination within the allotted time. This section reiterates the details of the Class B shares issued to the sponsor and the IPO itself. It is mostly a recap of what we've already seen. And finally, the exhibits list includes certifications from the CEO and CFO, which are standard requirements. So, what is the story here? Westin Acquisition Corp is a typical SPAC in its pre-IPO phase. They were busy setting up the company, incurring formation costs, and getting ready for their big debut. The numbers show a company with minimal assets and liabilities, purely focused on raising capital for a future merger. The crucial events, like the IPO and private placement, happened just after the reporting period, so this 10Q is really a look at the company before it started its active life as a publicly traded entity. The main takeaway is the significant injection of cash through the IPO, which now gives them the resources to pursue a business combination. However, the going concern doubt and the admission of ineffective controls are important points to keep in mind about the inherent risks and the early stages of their development. The true test for Westin Acquisition Corp will be how well they can execute the business combination in the coming months. Will they find a gem? Or will they be forced to liquidate? Only time and their next filings will tell. Alright, that is our breakdown of Westin Acquisition Corp's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives like this. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.